Welcome to the Deep Dive, the show where we cut through the noise and give you the most important nuggets of knowledge from the world of finance, business, and beyond. Today, we're taking an in-depth look at a company you might not actively track, but one whose impact on your investments and global capital markets is truly immense. MSCI Inc. Ticker symbol MSCI. Imagine a silent yet incredibly powerful control center for the world's investment data that's kind of MSCI. We're exploring a company that sits really at the very heart of how trillions of dollars are invested globally. Our mission today is to uncover if this powerhouse is truly a hidden gem, or if the market has already fully recognized its undeniable advantages. The conclusion we'll land on might just surprise you, suggesting it's a company of exceptional quality, but one that currently offers no significant margin of safety for new investors. So let's dig in and find out what that means for you.
That's absolutely right. MSCI isn't just another financial services firm, it's foundational. They provide the essential maps and tools that guide the world's largest capital allocators, a role that's become even more critical in an era defined by data-driven decisions, the explosion of passive investing, and the growing influence of factors like climate change. Our deep dive today is based on an analysis as of August 22, 2025, with MSCI's share price at $574.25.
Okay. To truly unpack this digital backbone of global finance, we've structured our deep dive into two main parts, with 7 distinct chapters. We'll start with the fundamentals, MSCI's business, management, and financials. Then we'll pivot to market perception, ownership, key risks, and of course, our comprehensive concluding outlook. Our mission today is to reveal its strengths, risks, and its true value for you. All right, let's begin with part 1, where we'll explore the business, management, and financial health of MSCI. To kick things off, let's dive into Chapter 1, Business Analysis. What exactly does MSCI do as this crucial financial data toll booth? How does it generate revenue?
Well, MSCI is fundamentally a leading provider of critical decision support tools and services for the global investment community. What truly sets them apart is their highly resilient and incredibly predictable business model. It's built around licensing annual recurring subscriptions, which clients often pay in advance. This model isn't just about steady income, it's about, unparalleled revenue visibility and stability. That means even during market volatility, MSCI's core cash flow engine keeps humming, a rare and valuable trait in finance.
That sounds like a remarkably stable foundation.
Right.
What are the primary engines driving that consistent revenue for MSCI? And how do those different streams contribute to its overall stability and growth?
Right. There are two main drivers. The first and foundational stream is recurring subscriptions. This is the stable, growing income base we just discussed, clearly evidenced by their index segment completing its 10th consecutive year of double-digit subscription run rate growth in 2023. That's quite a track record.
10 years straight, wow.
Exactly. It speaks to the stickiness of their products. The second stream is asset-based fees, or ABF. This makes up a substantial, though more variable portion of revenue, historically somewhere between 22% and 26% over the last 5 years. These fees are directly tied to the assets under management, the AUM, that are benchmarked to MSCI indexes. As of mid-2024, we're talking about a staggering $16.5 trillion in AUM benchmark.
$16.5 trillion. Okay. With such a resilient model, I'm curious, what are the specific products and services that truly make MSCI indispensable for their clients?
They offer a suite of highly integrated services. Their indexes are the cornerstone. They calculate nearly 300,000 equity and fixed income indexes daily. Flagship products like the MSCI World, Emerging Markets, and All Country World Index. Well, they're the primary global benchmarks for trillions in investment.
The ones everyone quotes.
Precisely. Then there are analytics. This provides sophisticated, often mission-critical tools for portfolio construction, risk management, and performance attribution. Next, and this is a major growth area, is ESG and climate. They offer in-depth ESG ratings, research, and innovative climate solutions like climate value at risk models. This helps investors integrate sustainability factors, which is huge now.
Increasingly important, yeah.
And finally, real assets, which encompasses private assets. This is a strategic initiative providing specialized data, benchmarks, and analytics for those illiquid private asset classes like real estate.
They sound incredibly central to the whole investment process. When we consider their market position and scale, just how dominant are we talking here?
Oh, MSCI truly occupies a dominant position. Their scale is immense. They serve over 700 clients across more than 100 countries, and this includes an overwhelming majority of the world's largest and most influential investors. 96 of the top 100 asset managers and 91 of the top 100 pension funds use their services.
That's almost everybody who matters.
Pretty much. And when you factor in the $16.5 trillion in AUM benchmark to their indexes and their ESG research covering over 13,000 corporate issuers, well, you grasp just how deeply embedded they are in the financial system.
So when we connect all this to the bigger picture, what's MSCI's core value proposition for you as an investor considering this company? What problem do they fundamentally solve?
MSCI's fundamental value proposition is that it provides a standardized, trusted, and integrated common language for the global financial ecosystem. They take vast amounts of raw data and transform it into high-quality, actionable insights. And crucially, their products aren't peripheral. They are deeply integrated into client workflows, supporting everything from, say, strategic asset allocation down to daily risk management. It's genuinely hard to operate in global finance without encountering them.
That makes a lot of sense. Stepping back a bit, what broader industry trends are fueling this growth and making their services even more essential?
Well, the financial analytics market itself is booming. It's projected to grow at something like an 11.3% compound annual growth rate, going from about $10.7 billion in 2025 to over $22.6 billion by 2032.
Healthy growth.
Very healthy. And this growth is propelled by several powerful secular trends. The huge structural shift towards passive and index-based investing.
Which directly benefits their index business.
Absolutely. Then there's the increasing complexity of global markets, the mainstream integration of ESG and climate factors into investment decisions, which we touched on, and just the broad adoption of data-driven decision-making across the entire industry. Now, they do face competition from heavyweights like S&P Global, Moody's, and FactSet, but MSCI holds a dominant, say, 47% market share for index products just across Europe alone. That illustrates their strength.
What about the regulatory environment and those barriers to entry you mentioned? Does regulation help or hinder a company like MSCI?
It's interesting. The financial data and analytics industry is subject to an increasingly stringent global regulatory framework, think GDPR in Europe, Sarbanes-Oxley in the US, plus specific rules for benchmarks and ESG reporting that keep evolving. Now, this creates high compliance costs and operational hurdles, definitely. But the interesting thing is that this complexity actually fortifies established players like MSCI. They have the scale, the resources, the expertise to navigate it.
So it acts as a barrier for newcomers.
Exactly, a significant regulatory barrier. And beyond that, the other barriers are exceptionally high. Massive fixed costs for technology and data infrastructure, a brand and reputation built over 50-plus years that's frankly impossible to replicate quickly. And crucially, those high customer switching costs and powerful network effects we keep coming back to.
This really does sound like a formidable economic moat. Can you break down MSCI's competitive advantage a bit more? Tell us what makes it so difficult to challenge.
Yeah, it's not just one thing. MSCI's durable competitive advantage is like a symbiotic system of mutually reinforcing strengths. First, you have brand strength. I mean, the MSCI World Index is a global standard, right? Built since 1968. That confers immense trust and authority.
Instantly recognizable.
Then, economies of scale. Their intellectual property and data infrastructure have high fixed costs to build and maintain, but a very low marginal cost to license out to another client. This leads to expanding profit margins as they grow. The network effects are incredibly powerful. The more asset managers, pension funds, ETFs adopt MSCI indexes, the more essential they become as that common language for the entire industry. Their value increases exponentially for everyone involved.
Right, because everyone else is using it.
Precisely. And this leads directly to high switching costs. Their products get so deeply integrated into client infrastructure risk systems, reporting, portfolio management, that it becomes financially and operationally costly and risky to replace them. That's why their customer retention rates are projected at a very high 93.9% for Q1 2025. It's sticky.
Very sticky.
So all this creates a powerful flywheel effect, strong brand network effect, deep client integration, high switching costs, stable revenue, which funds investment, leading to more economies of scale and innovation, which further enhances the brand. It feeds itself. And don't forget their unique assets, a vast proprietary database meticulously curated over 50 years, and world-renowned research and methodology capabilities. This isn't just a strong business, it's a fortress.
That's an incredibly powerful combination. But okay, even fortresses face threats. We'll get to risks later, but for now, let's shift gears to the people steering this formidable ship. We're moving on to Chapter 2, Management Evaluation. What can you tell us about their leadership's track record, especially through challenging times?
The leadership at MSCI is marked by impressive stability and success. Most notably, you have Chairman and CEO Henry A. Fernandez. He's been CEO since 1998 and Chairman since 2007. That's a long tenure.
Very long. Seen a few cycles.
He certainly has. And his tenure has been tested and proven through multiple market crises. During the 2008 global financial crisis, for example, the company delivered record revenues and EBITDA, that's earnings before interest, taxes, depreciation, and amortization. It gives us a clear picture of core operational profitability. That really demonstrated the resilience of their subscription model, even when asset-based fees took a hit. More recently, the COVID-19 pandemic actually validated their strategic focus on ESG, as their own research showed that companies with strong ESG profiles exhibited greater resilience during the downturn.
Interesting. Beyond their performance during crises, how transparent is MSCI's management and what's their ethical reputation like? Are there any blemishes?
Well, MSCI generally maintains a high degree of transparency. They have a comprehensive investor relations portal, regular earnings calls, detailed presentations. They even have an issuer communications team to engage directly with companies about their ESG assessments. However, it's important to acknowledge an ethical challenge that emerged in August 2023. A U.S. House Select Committee launched an investigation into MSCI's activities related to China.
Yes. What was the allegation?
The allegation was that its indexes channeled funds into certain Chinese companies that were blacklisted by the U.S. government. Now, this represents a significant geopolitical and reputational risk that investors absolutely must monitor carefully. It shows that even a leader in ESG isn't immune to complex ethical scrutiny, especially around geopolitics.
That's a critical point. Okay, shifting to capital allocation. Where is management investing the company's money, and how are they returning capital to shareholders?
Management's capital allocation strategy seems highly focused. It's about reinforcing the core business and capturing those major secular growth trends we talked about: indexing, customization, climate solutions, and private assets. They execute this partly through targeted, capability-driven acquisitions. Think Barra for analytics way back when, Risk Metrics, Carbon Delta for climate change expertise, Real Capital Analytics for real estate data, and most recently, Burgess Group for private assets data. These moves are designed to deepen their moat and increase client integration.
Smart bolt-ons.
Seems that way. They also have a very aggressive capital return policy, which, frankly, speaks volumes about their confidence in the company's vast, predictable free cash flow. This includes a massive share repurchase program. They bought back over 50 million shares for $6.6 billion between 2012 and 2024, significantly reducing the number of shares outstanding.
It's a huge amount.
It is. And on top of that, they have a consistent growing dividend policy. We're talking 11 consecutive years of increases. The dividend is currently at $7.20 per share annually, and it's been growing at a 3-year compound annual growth rate of over 22%. This dual approach really underscores management's confidence.
And a crucial metric for effective management: return on invested capital, ROIC. This tells us how well a company converts its invested capital into profits. How does MSCI stack up here?
MSCI's ROIC is truly exceptional. It currently stands at about 26.09%, with the trailing 12-month figure even higher at 33.99%. What's particularly telling here is the sustained upward trend. It has systematically improved from around 10% back in 2015 to consistently being above 30% in the 2023-2025 period.
Yeah.
This is a clear indicator of highly effective and, frankly, increasingly profitable capital deployment by management over a long stretch of time.
Okay, with the what and the who clearly defined, the natural next step is to examine the financial backbones supporting MSCI's formidable position. Let's crunch some numbers as we move into Chapter 3, Financial Analysis. What's the current financial snapshot look like?
Right. As of our analysis date, August 22, 2025, MSCI's market capitalization is approximately $44.1 billion. Its enterprise value is $47.41 billion, which indicates a net debt position of about $3.3 billion. They have 77.37 million shares outstanding, and that number, as we noted, is consistently decreasing year over year due to those active buybacks, down about 1.68% year over year. Their trailing 12-month revenue is just shy of $3 billion at $2.99 billion. Net income stands at $1.18 billion, and earnings per share, or EPS, is $15.09. The dividend yield currently sits at 1.29%.
Looking beyond the snapshot, what does a decade of their financial performance trends reveal about the underlying quality of this business?
It reveals a business of remarkable consistency, high profitability, and robust growth. Revenue growth has been strong and consistent. We're looking at a 5-year compound annual growth rate of approximately 13.9%, taking them from $1.70 billion in 2020 to $2.86 billion in 2024. Their profit margins are not just high, they're expanding. Trailing 12-month gross margin is 82.18%. Operating margin is 53.80%, and net profit margin is 39.46%.
That operating margin expansion is pretty impressive.
It's phenomenal, really, expanding from around 37.6% in 2015 to over 53% recently. That's significant leverage in the model. And when it comes to free cash flow, FCF generation, it's prolific. FCF nearly doubled from $789.3 million in 2020 to $1.47 billion in 2024. Their trailing 12-month FCF margin is a very strong 48.42%. This cash generation powers everything else: the buybacks, the dividends, the acquisitions.
Let's discuss financial stability for a moment. There are a couple of points here about their debt to equity and current ratio that might raise some eyebrows for listeners scanning the numbers.
You're right to highlight those, as they can be easily misinterpreted without context. Their earnings consistency is remarkable. EPS grew from $2.03 in 2015 to $14.05 in 2024. Very steady climb. Now, the debt-to-equity ratio, it shows a negative shareholders' equity of about negative $886 million. Okay, normally negative equity is a huge red flag.
Usually means liabilities exceed assets.
Exactly. But for MSCI, this is really an accounting artifact of their aggressive share repurchases. It's not a sign of financial weakness. If anything, it reflects the immense cash-generating power they've used to buy back shares over the years. Similarly, a current ratio of 0.86, that's current assets divided by current liabilities, typically signals liquidity risk if it's below 1. But again, it's misleading for a subscription-based business like MSCI. A significant chunk of its current liabilities is deferred revenue. That's cash they've already collected for services they haven't delivered yet. It's not a drain on cash, it's cash already in the bank.
So the strong free cash flow is the real liquidity indicator here.
Absolutely. That's the number to watch for liquidity. And their dividend stability and growth also underscore this financial strength: 11 consecutive years of increases and a recent 13.27% year-over-year growth rate. Solid footing.
So with all these strong numbers and those accounting quirks clarified, what does it all mean for valuation? Is MSCI trading at a reasonable price today, or is the market fully pricing in that quality?
Good question. Looking at relative valuation, MSCI trades at a trailing 12-month price-to-earnings, or PE, ratio of approximately 37.5. Now, historically, this is actually below its recent averages. Its 3-year average PE is 40.4, and its 5-year average is 47.8, so you could argue it's more reasonably priced than it has been in the recent past.
How does it compare to peers?
It's a mixed bag. It carries a premium compared to some like FactSet at 26.9 and Morningstar at 27.4, but it's roughly in line with, or even at a discount to, others like S&P Global at 42.8 and Moody's at 43.1. So it depends who you compare it to. For intrinsic valuation, we can use a discounted cash flow or DCF model. This tries to estimate the company's value based on its expected future free cash flow, discounted back to the present value.
Right, the present value of future cash.
Exactly. So for an educational DCF model, and the assumptions here are key, let's assume maybe 10-12% free cash flow growth for the next 5 years, tapering off to a 3.0% terminal growth rate, sort of like long-term economic growth. And we need a discount rate, the weighted average cost of capital, or WACC, which reflects the riskiness of those cash flows and the cost of funding. Let's use a range of 8.5% to 9.5%. Based on those inputs, this educational DCF model arrives at an estimated intrinsic value range of $550 to $650 per share. Understanding these inputs is crucial, as even small tweaks can significantly shift the valuation output.
Okay, we've built a really robust picture of MSCI's internal strength and its financials. Now, how does the market view all this? Let's transition into part 2. Here, we'll explore market sentiment, ownership patterns, the key risks, and finally bring it all together in our conclusion. Kicking off part 2, let's delve into chapter 4. Market sentiment. How is the broader market perceiving MSCI right now, especially given that premium valuation we just discussed?
Wall Street sentiment is generally positive, leaning towards optimistic. The consensus rating from 13 analysts covering the stock is a moderate buy. The average 12-month price target is $654.73, with the median target sitting at $607. Since the current share price, as of our analysis, is $574.25, this suggests analysts see potential upside from here.
But you mentioned sensitivity earlier.
Exactly. A recent event really highlights the market's high expectations and sensitivity. There was a significant 8.9% single-day stock price drop on July 22, 2025. This followed their Q2 earnings report, which actually only slightly missed consensus expectations. That, combined with some cautious commentary from management, was enough to trigger a sharp sell-off. It really shows how sensitive this stock is to even minor perceived decelerations in growth, because the valuation already prices in a lot of good news.
What about other market indicators? What are the so-called smart money doing, and what do the charts tell us technically?
Well, one indicator is short interest. It's exceptionally low at just 1.67% of the float.
Meaning very few people are betting against it.
Right. Think of it as the percentage of shares being borrowed to sell short, anticipating a price drop. This low number signals minimal conviction among investors that the price is going to fall significantly. In terms of technicals, looking at moving averages, the stock is currently trading above its 50-day moving average, which was $561.81. That typically suggests positive near-term momentum. Interestingly, though, the price is almost exactly at its 200-day moving average, which was $574.11. That's often seen as a critical long-term support or resistance level, so it's kind of at an inflection point.
That's a fascinating point about this apparent tension you just mentioned between the strong long-term fundamentals and these very sensitive short-term market reactions.
Exactly. There's a clear tension here. On one hand, you have a bullish, long-term fundamental view supported by that analyst consensus and the extremely low short interest. People believe in the story. But on the other hand, the stock's premium valuation makes it highly sensitive to any short-term news or earnings blip. This causes volatility driven by those very high expectations baked into the price. It's a company investors clearly want to own for the long term, but they're quick to punish any perceived wobble in the near term.
Okay, let's move on to Chapter 5. Ownership structure. Who actually owns a piece of this company, and what does that tell us about its standing in the investment community?
The ownership structure is quite telling. Institutional ownership is extremely high. 94.36% of the shares outstanding are held by institutions like mutual funds, pension funds, endowments. This clearly indicates that MSCI is a core, high-conviction holding for sophisticated institutional investors. It's basically a staple in many large fund portfolios.
So it's not really an undiscovered stock.
Not at all. Now, insider holdings, by contrast, are relatively low at 3.31%. That's the shares held by directors and executives. However, what's particularly noteworthy here and quite recent are the significant open market purchases by Chairman and CEO Henry A. Fernandez. He bought over $6.6 million worth of stock in late July 2025, shortly after that Q2 earnings dip we discussed.
Buying the dip himself.
Exactly. That's generally seen as a powerful and pretty unambiguous signal of his confidence in the company's prospects and his belief that the stock was potentially undervalued at that point. It stands out, especially when contrasted with some less significant sales by other directors around the same time.
So what are the implications of such concentrated ownership by institutions? Does that affect how the stock trades?
Yes, it can. When a stock has such high institutional concentration, it means its price and trading behavior can be heavily influenced by the decisions of a relatively small number of large fund managers. If a few major holders decide to significantly increase or decrease their positions, it can potentially lead to increased volatility, maybe more pronounced swings, compared to a stock with a more dispersed ownership base.
Makes sense. Okay, no investment is without risk, and MSCI, despite its strengths, is no exception. Let's dig into Chapter 6. Risk assessment, maybe using a SWOT analysis framework, strengths, weaknesses, opportunities, and threats.
Okay, let's break it down. Their strengths are formidable, as we've discussed. Dominant market leadership and brand recognition. That high-margin, recurring subscription revenue model, a wide and durable economic moat built on switching costs and network effects, decades of expertise and intellectual property, and exceptional free cash flow generation coupled with high ROIC. Those are powerful positives. For weaknesses, we see that significant revenue exposure, 22% to 26% to asset-based fees, which makes them directly sensitive to market downturns. Equity markets fall, their ABF revenue falls. There's also been a noted recent deceleration in net new subscription sales growth, which creates some near-term uncertainty and feeds into that market sensitivity we talked about. And while we clarified it earlier, their negative shareholders' equity, even though it's an accounting artifact, could still be misinterpreted by some investors or screened negatively. Looking at opportunities, there's the growing global demand for ESG, climate, and sustainability data. This is huge, driven by both investor demand and increasing regulatory requirements. MSCI is well positioned here. They also have significant expansion potential into the large and growing private assets market. Think private equity, private debt, real estate. There's also increased adoption potential by the wealth management channel, not just big institutions. And of course, the ongoing ability to upsell and cross-sell more integrated solutions to their massive existing client base. Lots of runway there. Finally, the threats. There's intense competition from large, well-funded financial data providers like S&P Global and Moody's, who are also investing heavily. There's always persistent fee pressure from clients, especially large institutions trying to manage their own costs. You have the potential for disruptive technologies, maybe advanced AI fundamentally changes data analysis, or perhaps decentralized finance models emerge that challenge centralized index providers, though that seems further off. And then there are those critical geopolitical risks, especially concerning China regulations and the potential fallout from that U.S. congressional investigation into their indexing practices. These are real and need monitoring.
How do big-picture macroeconomic factors, like persistent inflation and rising interest rates, affect a company like MSCI, which isn't, directly making physical goods?
Right. A macro environment with sticky high inflation and rising interest rates poses a kind of dual threat for them, even though they're not manufacturing anything. Firstly, it can lead to budget constraints for MSCI's clients, those large institutional investors. They might slow down new subscription purchases or push harder on pricing. That could pressure revenue growth. Secondly, higher interest rates increase the company's own cost of capital, making debt more expensive. More importantly for valuation, higher rates mean investors use higher discount rates in those valuation models we discussed, which makes the present value of future cash flows lower, potentially compressing the stock's valuation multiple.
And what about specific geopolitical events? Let's use a hypothetical, like, say, the U.S. imposed tariffs of 2025 mentioned in the outline. How would something like that ripple through to MSCI?
Well, while MSCI isn't directly involved in importing or exporting goods affected by tariffs, such an event could easily trigger a broader global economic slowdown or even a recession. And that would negatively impact MSCI in two primary ways. First, a broad decline in global equity markets would directly hit its significant asset-based fee revenue. Lower AUM means lower fees. Second, a recessionary environment would almost certainly compel institutional clients to tighten their budgets significantly, reducing demand for new products, maybe delaying upgrades, and potentially leading to lower client retention rates or more pricing pressure. So even a toll booth isn't immune if the overall economic traffic slows down significantly.
Right, that makes sense. Okay, we've really deep dived into MSCI now. Let's bring it all together for Chapter 7, Conclusion. Let's synthesize our findings and start by clearly articulating the key bull case for this company. Why would someone be optimistic?
Okay, the bull case is frankly incredibly strong on a fundamental level. MSCI is arguably a best-in-class company operating with a wide and durable economic moat. Its role in the global financial system is indispensable, almost like critical infrastructure. This, combined with that high-margin recurring subscription revenue model, positions it to generate substantial and predictable free cash flow for years, maybe decades to come. It's also favorably exposed to powerful secular growth trends. Passive investing isn't going away. ESG integration is accelerating. The need for private asset data is exploding. And you have a long-tenured, proven management team with an exceptional track record of effective capital allocation, returning huge amounts to shareholders while still investing for growth. It ticks a lot of quality boxes.
And what about the bear case? What are the primary concerns or reasons for caution for investors looking at MSCI today?
The bear case really centers on valuation and sensitivity. Its exceptional quality isn't a secret. It's widely recognized by the market, and this is clearly reflected in a premium valuation, even if it's off its historical highs. This premium makes the stock inherently vulnerable to market corrections or downturns, and that vulnerability is amplified by its direct exposure to market levels via those asset-based fees. Furthermore, any sustained slowdown in subscription growth, even if it's still growing but just slower than expected, could lead to a sharp PE multiple contraction as the market recalibrates those high expectations. And finally, those evolving regulatory and geopolitical risks, the scrutiny around ESG ratings, the ongoing China investigation, these pose potential headwinds that could impact sentiment, operations, or future growth opportunities.
So bringing it all together with our valuation insights, what's the ultimate verdict on MSCI's stock price today? Is it a buy, sell, or hold based on this analysis?
Well, to reiterate, MSCI currently trades at that TTM-PE ratio of about 37.5. That's below its recent historical averages, which is somewhat positive, but still represents a premium compared to some direct peers. Our educational DCF model, based on what we feel are reasonable assumptions for future growth and discount rates, estimated an intrinsic value range of $550 to $650 per share.
And the ultimate concluding outlook then for you, the listener, who might be considering an investment in MSCI right now.
MSCI's current share price, $574.25 as of our analysis date, falls comfortably within that estimated intrinsic value range of $550 to $650. This suggests the stock is likely fairly valued by the market today. The price seems to appropriately reflect its exceptional quality, its dominant competitive position, and its predictable long-term growth prospects. However, and this is the crucial takeaway for new investors considering putting capital to work today at this current level, the stock does not appear to offer a significant margin of safety. It's a fantastic, high-quality company, no doubt, but you'd likely be paying a fair price for it, not getting a bargain.
This raises an important final question for you, our listeners, to ponder. Given MSCI's almost toll booth-like position in global finance and its apparently fair valuation today, what unexpected shift in global capital markets, perhaps driven by AI, regulation, or geopolitics, could either cement its indispensability even further, making today's price look cheap in hindsight, or fundamentally challenge its value proposition in ways we haven't fully considered yet? Something to think about. Thank you for joining us on this deep dive into MSCI Inc. We hope this analysis has provided you with valuable insights into a truly fascinating and influential company, one that probably impacts your investments more than you might realize. If you found this deep dive valuable, please remember to like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
Absolutely. And just a reminder, our $4.99 per month members get priority deep dives on tickers they request. Plus, over the next few months, we're planning on covering all of the S&P 500 stocks, and members get exclusive priority access to those analyses. If you just want a one-off deep dive on a specific company, you can always drop us a super thanks on YouTube. And the important disclaimer. Please remember, this analysis was generated by an AI system primarily for educational purposes and should not be considered financial advice. Investment decisions carry risk. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Until next time, keep diving deep.